Welcome to the deep dive. We've got quite the set of documents today. A company's financial statements.
Mhm.
The balance sheets, income statements, cash flows, really the core stuff.
That's right. And our mission really is to cut through the complexity. We want to pull out the key insights so anyone can get a quick handle on a business's financial health.
Exactly. No getting bogged down in jargon.
Yeah.
We'll focus on, let's see, the balance sheet, what it owns and owes.
Mm,
The income statement, its performance over time.
right. Profit and loss.
The cash flow statement, tracking the actual cash moving around. And we'll touch on the statement of changes in equity, too.
Yeah, basically how the owner's piece changes. But first things first, you really need to grasp what the company does. What's their business?
That context is crucial, isn't it? Otherwise, the numbers are just numbers.
Precisely. These statements tell the story of how that business is performing financially. So knowing the business model helps make sense of it all.
Okay, so let's start with the income statement. That's the one showing performance over a period like a quarter or a year.
Exactly. You've got revenue at the top, that's money from sales or services. Then you subtract all the expenses, the costs of doing business.
And what's left is the net profit.
Yeah,
Or, well, sometimes a loss.
mostly profit.
Hmm.
But yeah, the key questions are simple. Is that revenue growing?
Hmm.
Are expenses under control? Are they rising slower than revenue?
And ultimately, is it actually profitable? Is that profit margin getting better or worse?
Those are the core performance questions you ask there.
All right, next up, the balance sheet. This one's different. It's like a snapshot, right? A specific point in time.
Perfect analogy. It shows assets, everything the company owns that has value, like cash, buildings, equipment.
Okay.
Then liabilities, what it owes to others. Think loans, supplier bills.
Mhm.
And finally, equity. That's the owner's stake, essentially assets minus liabilities.
So when looking at this, we should be thinking, are assets growing? Is that a sign of expansion?
It can be, yes.
Yeah.
Also, how much debt does it have? Are liabilities really high compared to equity? That could mean more risk.
And is the owner's equity value increasing?
Yeah.
Is the business building value for them?
Exactly. And we can use a couple of quick ratios from this. For instance, the current ratio,
What that one tell us?
it's current assets divided by current liabilities. Basically, can the company pay its short-term bills, those due within about a year?
Okay, so higher is generally better.
Generally, yes, above 1 is good, but too high might mean they aren't using assets efficiently.
Right.
Then there's the debt to equity ratio.
Debt versus owner's stake.
Uh-huh. It shows how much the company relies on borrowing compared to the owner's funds. A very high ratio often signals, well, higher financial risk.
Makes sense. Now, the cash flow statement.
Yeah.
You mentioned this isn't the same as profit.
Not at all. Profit is an accounting measure. Cash flow is about the actual cash coming in and going out. It's vital.
So how's it broken down?
Usually into 3 parts. Operating activities, that's cash from your main business operations. Super important.
Right.
Investing activities, buying or selling long-term assets like property or equipment. And financing activities, cash related to debt, loans, paying dividends, issuing stock.
So you want to see positive cash flow
Yeah,
from operations, ideally.
definitely. That shows the core business is generating cash. You also look at, are they investing heavily? Are they borrowing a lot or paying back debt? It tells a story about their strategy.
So if someone wants a quick checkup without getting lost in the weeds, are there key ratios?
Yeah, a few simple profitability ones are great. Gross profit margin, that's gross profit over revenue,
Yeah.
shows profitability of the basic product or service.
Before overheads and stuff.
Exactly. Then net profit margin, net profit over revenue. That's the overall profitability after all costs.
Okay.
And maybe return on equity, or ROE, net profit divided by shareholders' equity. It shows how well they're using the owner's money to generate profit.
These sound like useful shortcuts.
They really are. They help standardize things and make comparisons easier.
And I guess just looking at one report or one period isn't the full picture.
Absolutely not. The real insight comes from trends. Look, year over year, quarter over quarter. Are things improving, getting worse? Are debts piling up? That trend analysis is critical.
Good point. And you mentioned the notes earlier. People actually read those?
Huh. Well, they should. Seriously, the notes to the financial statements contain really important details. Explanations of accounting policies, breakdowns of numbers, context you just don't get from the main statements alone. Don't skip them.
Okay, noted. So, boiling it down for someone who's not an accountant, what's the mindset?
Just ask simple, fundamental questions. What are these numbers telling me about the business? Is it growing? Can it pay its bills? Is it using its resources wisely? Focus on the story behind the numbers.
That really clarifies things. Understanding these core bits really does seem to demystify a company's financial health.
It empowers you to ask the right questions, definitely.
So, wrapping this up, here's something to think about. Now that we've looked at the financial side, what sort of non-financial things, maybe real-world observations, might you pay more attention to, knowing what these numbers could reflect?